Welcome to the daily insights that matter. Now, the global oil market just got shaken up. Yesterday, OPEC and its allies announced a surprise decision to cut oil production even further, sending oil prices soaring by over $5 a barrel in the market's opening today. Now, this move is an attempt to stabilize the market amid concerns of oversupply and a slowdown in demand. Let's discuss this. OPEC Plus, that is the organization of the petroleum exporting countries and their allies including Russia, just announced a cut in oil production by 1.16 million barrels per day. Now, this is in addition to their previous announcement of a production cut by 2 million barrels per day until December, which is already in effect. So effectively, now the total cuts amount to 3.66 million barrels per day, or 3.7% of the global demand. Now, this move is in line with the strategy of OPEC and its allies to act proactively, as they can do so without significant losses in their market share. Now, while unexpected, this cut could be economically and politically significant, and analysts predict a 7% increase in oil prices, which could boost OPEC Plus's oil revenues. Now, India is the world's third largest oil importer and gets more than 70% of its crude oil from OPEC and its allies. Now, these 23 oil-rich nations, along with 10 partner nations like Russia, control almost 40% of the global oil production. Now, the recent reports show that India has increased its import of cheap oil from Russia, which is now the second largest supplier to India after Saudi Arabia. Now, yesterday's decision of production cuts by OPEC and its allies will potentially impact India's oil imports and prices as well. Now, as India relies heavily on imports from OPEC plus countries, any production cut would lead to a reduction in supply, which could drive the prices upwards. However, India has been diversifying its sources of crude oil, including increasing the imports from countries like US and Russia. Therefore, the impact of the production cuts may be mitigated by these alternative sources, but to a certain extent only. Having said that, it is worth noting that the full impact of the production cuts on India's oil industry and the economy will depend on various factors, including global demand and the geopolitical developments. Now, output of India's 8 core sectors rose by 6% in Feb 2023 against a growth of 5.9% seen in the same month last year. Now, this growth happens to be the slowest in the past 3 months. Now, the core sector index is an index of the 8 most fundamental industrial sectors of the Indian economy, and it maps the volume of production in these industries. These sectors have significant links with other industries and therefore have the capability to strongly impact the Indian economy collectively. Now, the core sector number normally has larger ramifications for the index of industrial production and the GDP growth as well. Now, the 8 core sectors comprise almost 40.27% of the weightage in the index for industrial production, which is an index to track manufacturing activity in different sectors of the economy. Now, in February, apart from crude oil, all the other sectors witnessed a growth, indicating a broad-based industrial recovery on a yearly basis. However, if compared to the month-over-month data, there has been a decline overall, with crude oil being the leading dragger. Now, this implies that there is a weak recovery in the core sector on the back of fears of a global slowdown. Now, the 6% growth in the core sector implies that the recovery is weak and losing momentum due to global economic uncertainty. But the output in core sectors stood higher than the pre-COVID levels of Feb 2020. Now, the sudden hawkish behavior of the central banks, along with the fears of a global slowdown, are weighing in on the core sector output. Going forward, the significant capex push by the government announced in the recently concluded budget could weigh positively for the core sectors. So what does all of this news mean for you? Higher global crude oil prices is not good news for India, as it depends heavily on imports. Crude oil prices are expected to remain volatile, as there are a number of factors at play which are feeding into the highly uncertain outlook. This will therefore have an indirect negative impact on you for time being. Now, amid multiple headwinds such as high inflation, rising interest rates and supply chain constraints, Indian core sector output has been affected to a certain extent. However, the Indian economy has stayed resilient despite the global slowdown. This will therefore have an indirect neutral impact on you for time being. While I say this is Raj Mehta signing off, wishing you and your loved ones the very best. Thank you.
Did you like watching this video? Then download our app Informed Investor to watch more such informative and interesting videos.